Hey guys, welcome back to the channel. In today's video, we're going to be talking about cash, everything that's going in the financial system, and is your cash safe? That is a big question, guys, that a lot of people have. Should you be worried about your money within the United States banking system? That is a great question, and that is what we are going to get into. So over the last week, we've seen the failure of Silicon Valley Bank. We've also seen Signature Bank. We know they kind of got financial backing at this point from the government, but the question is, can a bank run be possible? How the FDIC kind of coverage works. We know looking back to 2008 when we seen some bank failures, it is unexpected and it is usually extremely rare to see a bank fail. That is the reason why we only seen two that fell within the US. If you've seen the news recently, Credit Suisse kind of seen the same thing, but President Biden stepped up again, did a sort of a bailout, kind of backed the banks, said every American should feel confident their deposits are there when they need them. The question is, if an institution is shut down from the FDIC, such as Silicon Valley Bank, how long does it take to get those funds back? That is still kind of yet to be seen. I know some of the funds were made available for people who were in there, but again, some of it has not been made available to some of the larger institutions from reading this article. So first question, guys, what is a bank run? Since banks takes customer deposits, they invest the funds, the cash might not be on hand. This is what happened. So if everyone literally wants to withdraw all of their money at the same time, that is what happens on a bank run. When you look at some of the financial institutions of what we just seen, when you have $40 billion that is removed from a financial institution, the chances are most of the financial institutions do not traditionally have that much money on hand, which is the reason why we seen the Silicon Valley Bank and everything went with that. This creates a panic. So a lot of people think that they're not going to get their money. They run to the banking system. They take out all of their cash. They move their funds. They take it in checks, things of that nature. Well, the other big thing to really keep in mind, guys, is the speed of technology. Transactions are done instantaneous for a lot of places, which is the reason why 24 to 48 hours, banks can go absolutely broke because of the high percentage of the uninsured deposits that they have, but also the large risk of very, very big withdrawals. That was the case with Credit Suisse. There was actually, I believe it was a Saudi Arabia bank or financial backer that removed an incredible amount of money, but then the Swiss bank stepped up and said, we'll cover everything, don't have to worry about it, and that is exactly what they did. So could we see a run on the banks? Possibly, yes, we definitely could. I know right now they have a lot of things that they're trying to put in place to really keep this from happening, including a kind of a standby fiduciary where if these financial institutions cannot meet their demands, they're going to be able to borrow essentially on the government versus some of the government bonds that they have. So again, it's going to be kind of interesting when they work out all of the details, exactly what this is going to do and how the government is going to kind of cover it. Now, the question is, again, is your money safe? Yes, your money is covered by the FDIC. If you are a banking customer, your money is covered by the NCUA. If you are a credit union customer, no depositor has lost FDIC insured money since 1933, guys. That is the real purpose of the FDIC. Banks purchase the insurance to protect the consumer up to a certain amount, and right now it is $250,000 per depositor, but it is by per ownership category. You can actually have far more than $250,000 of FDI coverage depending on how your accounts are structured, which you definitely want to look at, ensuring they have beneficiaries, ensuring they have joint members, making sure again that your accounts are fully covered. Also, FDIC insurance is per institution. So if you have 3 institutions and you're an owner on all of those accounts at 3 institutions, it is going to be separate FDI coverage for each institution that you do your banking, which again, a lot of financial advisors do suggest splitting up the funds between multiple financial institutions. I know it does make it a lot more difficult to track. However, when you break it up that way, you are covering all of your funds. So let's say you have $1 million, you have 4 institutions that have $250 each. You are 100% insured through the FDIC or the NCUA that your funds will be covered. Also, some brokerage accounts are used for government-backed securities. There's a lot of other avenues than literally just keeping your money in banks, keeping it in CDs that do have a little bit of a higher yield. The big question also is, how is this different than 2008? In 2008, we know we seen bank failures. The big thing is, again, with the advancements of technology, and when I ultimately look at 2008, this is the way that I view it. In the housing market, everything that happened in 2008, 2009, the financial crisis, was really fundamentally what financial institutions were doing with their lending policies. That is one of the very big things. And again, that is how I view it. Because we didn't have as many rules and regulations in place when it came to the mortgaging, really caused the domino effect of the housing market. Now, this day and age, guys, a couple other things to really take into account of, where we are today compared to where we are or where we were in 2008. One, cryptocurrencies. There's an incredible amount of cryptocurrency out there. There's a lot of money invested in cryptocurrency. And the thing is, crypto transactions work 24/7 and they work lightning fast. You're not waiting, a day or a week or 7 days, 10 days, whatever, till your funds become available in a financial institution. In the crypto market, things do happen in real time. Transactions can be done, money can be moved, which does make it a much riskier asset. And then in the case of SVB, where they had a lot of tech startups, they have a lot of high probability or higher probability of running into issues. A lot of tech startups don't continue. We see a lot of them going out of business and a lot of them having issues or needing an incredible amount of capital. So some of the loans that SVB was doing, a lot of other institutions, a lot of financial centers would not lend to what they were doing, which is the reason why there was really a big niche where SVB was needed to really start and fund these tech startups, because those are some of the revolutionary things that are completely changing the world. So guys, overall, is your money safe? Yes, it is. Financial institutions have been backed by the government. They've been backed by the FDIC. And again, depending on exactly how much you have in your cash balances across multiple institutions, you can actually cover it in its entirety. Are we going to see a bank run? Unlikely. I think even now we've seen a majority of the stocks recover over the last couple days. Even the whole financial banking sector has kind of recovered. Plus some, it seems like there's a lot of financial institutions that were down considerably. 20, 30, 40, 50% that have since recovered in a very short amount of time. So is the panic over? Could and might not be, but should you be prepared? Absolutely, guys, which is the reason why I wanted to go over this. So is your money safe up to a certain amount with the FDIC? Is it safe past that? That is really up to you to do your own research in the financial institutions that you're investing your money in and where you do keep it. If you're keeping your $1 million in one single place, some of it might not be covered by the FDIC, again, or the NCUA based on the ownership of those accounts. But it is still only comes in effect, and this type of thing only happens if the banks are insolvent, if they cannot provide liquidity, which a majority of them are. I know a lot of financial institutions at this point are sitting very, very cash heavy, just to wait out and see exactly what this is going to do. So, all right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.